Central bank economic forecasts are about as accurate as the average height of men's Tinder profiles. Despite months of Trump babbling on that tariffs would happen, economic forecasts didn't predict any tariff impacts on the US economy until they were formally announced in April. Despite the clear signs of looming lockdowns in late 2019 and early 2020, economists did not predict a market crash until March 2020, when it was already happening. So why the fuck are economic forecasts always wrong? Why does anyone read them? Does anyone actually know what's going to happen before it happens? And is there a place you guys can get answers and make good investment decisions before all of the normies? You're watching Macromind, and I intend to answer those questions. Economic forecasts are produced by a few different groups, and they aim to achieve different things. Central banks produce forecasts so that they have a quantitative rationale to make changes to monetary policy, aka interest rates and quantitative easing. They also produce forecasts so the government can plan its fiscal policy and make decisions about the country's future. Commercialized banks like Goldman Sachs, JP Morgan, and the rest make economic forecasts at both the country and the company level, aimed at serving the investors in publicly listed companies so that they can make decisions on their investment portfolios, and so the senior leadership of major corporations can make strategic decisions about what markets they operate in and what goods and services they produce and who they trade with. When it comes to commercial banks making country-level forecasts, they offer a balancing act for central banks' estimations and essentially informally assess whether the central bank's projections are reasonable or if they've been smoking too much propaganda, aka propaganda. Commercial banks then come up with their own forecast, forming their own viewpoint on a country's future, which they call a house view. This is not to be confused with what credit agencies do, which is more focused on the debt default risk associated with a given country or company. Here's why we need commercial bank forecasts on top of central bank forecasts. This chart shows how the US Federal Reserve changed its forecast for US core PCE inflation over the last few years. For those of you who are not finance bros, core PCE inflation means consumption inflation, excluding food and energy costs. This measure is used by the Fed, as food and energy costs have more price volatility than other consumer goods, which ruins the data and makes it hard to interpret. As you can see from this chart, the Fed was always either under-predicting rises in inflation or over-predicting the speed of decline of inflation. This is like when you've gained a few pounds and your girl is questioning you, so you downplay how fat you've gotten, and in order to keep her around, you insist the road to six-pack abs is actually a lot shorter than it is. Any economist worth their salt during 2020 would have understood that global lockdowns would have major supply chain disruptions, which would drive up prices in the medium term. So why did the Fed and Jerome Powell, who presumably knew about this, not reflect it in their forecast? In times of macroeconomic turbulence, investors and business leaders have increased uncertainty, which in the best case scenario makes them pause and think before they take action, which drags out timetables for major business development projects which were intended to increase company profits, and therefore GDP growth in that country is slowed. In the worst case scenario of uncertainty, companies and investors begin to retreat, meaning investors sell American stocks and American companies try and reduce the percentage of their revenue coming from the US. That's exactly what's happening right now with the tariff situation, and it caused a year's worth of S&P gains to be wiped out overnight. When this uncertainty exists like it did during 2020, and like it does with tariffs today, those central bank projections are significantly more likely than usual to cause large reactions. So in order to suppress the market's response to signs that suggest inflation might rise, the Fed will underproject the expected increase in inflation. As things begin to get worse, the central bank will slowly increase its projections, which give you the impression things are somewhat under control because there's no massive change in each individual forecast that the central bank issues. Then when people get really scared inflation is still going up, the central bank changes its forecast direction, suggesting inflation is going to come down in future quarters. This calms investors and business owners so that they act in a way that's favourable to the US economy. Because central banks are trying to suppress the market's reaction to economic events, they will always give a very conservative view of how bad things will be in a negative economic scenario. On the flip side of this, commercial banks' economic research analysts don't have the same level of responsibility to keep markets calm. So if you look at their forecasts and compare them to the central bank, they're almost always more aggressive and closer to what happens in reality. But even still, we find that commercial banks are still underestimating what's going to happen in their economic forecasts. This happens because unlike central banks, where there's a lot of ambiguity around who the actual person was who came up with the forecast, with commercial banks, the research analysts are very well known, and at the top of every publication, it very clearly says which analyst in the bank wrote that paper, and sometimes has a picture or video of them embedded within that paper. So at the individual level, there's a lot of reputational risk in them incorrectly forecasting large changes in major economic metrics. The bank's analysts know that just because the evidence they have available on a certain day suggests one thing might happen, for example, Trump announcing major tariffs which would indicate a high probability of a US recession, does not mean that that will actually end up happening. That's why Goldman Sachs ended up in a very awkward position a couple of weeks ago when they forecast a recession off the back of tariff news, and then literally 2 hours later, updated the forecast to say that there would not be a recession because Trump had changed his mind. To avoid this, the high-level forecast numbers research analysts come up with might still be conservative, albeit less conservative than the central banks. But the critical difference is, When you actually read the contents of a commercial bank's research paper, if you read between the lines, you'll get an indication of the economist's true viewpoint, which usually indicates something more extreme than what the numbers say, because no major news outlet's going to quote paragraphs and paragraphs of a research paper, but they will plaster the headline forecast numbers on CNN and Bloomberg. New analysts' forecasts have the ability to move markets significantly in the short term, because the same large group of major investors have access to the same bank's research portals. In other words, you have to read them because everybody else does. If an influential bank like Goldman releases an extreme view on a country or company's future, that has a real-time impact on the market price of stocks in that country, as more nimble institutions make fast decisions off the back of it. Over the course of the next 24 hours, information about that research article spills into the major news flow, which is where the rest of the market hears about it and reacts accordingly, meaning it's better to have access to those research papers sooner before there's any market movement. When a company is going to release a quarterly or yearly earnings report, the bank's research analysts usually receive this data a few days in advance so they can analyze all the information and prepare to release their research paper the moment the earnings report is publicly released. This means as an investor or business owner, once that earnings report is out, instead of you having to make fast and superficial decisions off of the numbers to get ahead of the market and risk coming to the wrong conclusions, instead you can sink your teeth into a hopefully well thought out, detailed analysis of the results by another expert and make decisions based on that. The real value in research reports is the words written, not the numbers printed, because the actual words discuss possible scenarios of a company or country's future performance, considering as many angles as reasonably possible. So whilst the high-level numbers have to make a decision and suggest the analyst's viewpoint, the actual discussion content can be really broad. But as a retail investor, you don't have access to banks' research platforms, which means you only hear about things from secondary or tertiary sources, such as when a YouTuber makes a video about an event 2 days after it happened. To combat this time lag, the first thing you should do is build a base level understanding of macroeconomics so that when new data comes out, for example, manufacturing PMIs, you can go to a free trading platform like Trading Economics and make quick judgments about the implications of the data. However, in my personal view, by the time the numbers come out, it's already too late to make any meaningful changes to your portfolio. This is because in the time it takes you to manually review some economic number releases, a quantitative algorithm has already analyzed it instantly and executed trades off the back of it. So by the time you do anything, the market movement has already occurred. Which is why great investors don't wait to look for new numbers to appear before they take action. If we take 2024 as an example, Warren Buffett was very aware that Trump was likely to become president again, and he correctly anticipated a lot of market volatility and uncertainty in the coming years driven by Trump's increasingly aggressive rhetoric around tariffs and global trade. He realized that would dampen the US stock market's growth, regardless of whether tariffs came into effect or not, and decided to accumulate a massive cash position to de-risk himself to that volatility, and give himself ammunition for potentially getting discounts on company shares during the chaos. If you want to know how companies are going to sneakily evade tariffs this year, you should watch this video next.